The Aditya Birla Group's announcement of its entry into the cables and wires segment has sent shockwaves through the industry. Shares of major players, Polycab India Ltd, RR Kabel Ltd and KEI Industries Ltd plunged over 19% on February 27th, reacting to the news that UltraTech Cement, the group's flagship company, is venturing into the cables and wires space. The top four listed players in the segment lost more than 26,000 crore rupees in a day on February 27th. This unexpected move has sparked widespread concerns about heightened competition and potential margin pressures for existing players. Among the affected stocks, Polycab India Ltd, the segment leader with an 18% market share, witnessed the sharpest decline on that day. This scenario mirrors the Aditya Birla Group's earlier disruption in the paints industry when Grasim Industries entered the market with Birla Opus, shaking up incumbents. The big question now is, will history repeat itself in the wires and cables sector? Can Polycab sustain its growth momentum and deliver on its 5-year vision, the management guidance, despite the looming competitive threat? Let's dive into the potential impact on Polycab and the broader industry in today's episode of Bottom Line by Grow. I'm Radhika Bajaj. Let's start by understanding more about the company Polycab India Ltd. Polycab India Ltd is a leading manufacturer of wires, cables and fast-moving electrical goods or FMEG with a well-established presence in the industry. It caters to both domestic and international markets. It has 28 manufacturing plants located across key states in India. The company operates across 3 primary segments, with wires and cables being its core business. Apart from cables and wires, Polycab has expanded into the FMEG or fast-moving electrical goods sector, offering products such as switches, switchgears, fans, lights and other electrical appliances. The company also benefits from robust manufacturing capacities across all its key product segments, which plays a crucial role in driving its growth. Its well-integrated and scalable production facilities enable the company to meet rising demand efficiently while maintaining quality and cost advantages. The cables and wires segment alone contributes nearly 80% of the company's total revenue, making it the backbone of Polycab's operations. But the products are well diversified within this segment. While the FMEG segment is still growing, it currently accounts for about 8% of the company's revenue. Additionally, Polycab has a presence in EPC or engineering, procurement and construction space, which contributes around 9% to its overall earnings. As the market leader in the cables and wires sector with an 18% market share, Polycab has maintained a strong foothold in the industry. This is despite no single player holding more than 20% market share in the wires and cables industry. Let's take a look now at the company's performance over the years. Over the past 5 years, Polycab India Ltd has consistently delivered strong double-digit growth, compounding its business at an impressive pace. Between FY19 and FY24, the company's revenue grew at a CAGR of 18%, while EBITDA and PAT expanded at 21% and 29% CAGR respectively. Notably, its net cash surged at a staggering CAGR of 117%, reflecting robust financial health and efficient capital management. The company's balance sheet is healthy. It has negligible debt levels. Its debt-to-equity ratio as of FY24 was at 0.01 times. And with sufficient cash balance, this company is mostly debt-free. With the capex plans of 8,000 crore rupees announced for the next 5 years, the company may use some debt to fund the same. Before UltraTech's entry into the market was announced, Polycab stock has delivered 20.4% returns in the past year to investors. This strong performance was driven by the company's dominant market position and consistent business growth over the years, reinforcing investor confidence in its long-term potential. Now on to its recent performance. In Q3 FY25, the company reported 20% year-on-year revenue growth, with EBITDA rising by 26% during the same period. However, on a quarter-on-quarter basis, revenue saw a 5% decline. Yet, EBITDA margins improved to 14% in Q3 FY25 from 13% in Q2 FY24 and 11.5% in Q2 FY25. So what drove EBITDA growth despite a decline in top-line performance? The primary triggers behind margin expansion were efficiency improvements and cost optimizations. Material costs dropped by 2%, leading to a 300 basis point improvement in operating margins. Also, according to the management, the normalization of margins in the wires and cables segment played a crucial role. Margins in the wires business rebounded from the previous quarter's lows, while the contribution from international business exceeded 8%, returning to its usual levels from last year. Another key factor was the reduction in losses within the FMEG segment. This improvement was driven by higher contribution margins and gains from economies of scale as sales increased. However, these positive developments were partially offset by a moderation in margins in the EPC business. Further, in its latest December quarter earnings, management confirmed that it had successfully met its 5-year guidance and laid out a roadmap for the next 5 years. The company has outlined ambitious targets, a capital expenditure plan of 6,000 crore rupees to 8,000 crore rupees. The company's management expects margins in wires and cables to range between 11% and 13%. FMEG EBITDA margins are projected between 8% and 10%. Additionally, the dividend payout is set to exceed 30%. And exports are anticipated to contribute more than 10% of the total revenue. This apart, Polycab's management also highlighted that its strong order book should sustain growth momentum in the fourth quarter. With channel inventory at normal levels and copper prices on the rise, demand for wires is expected to rebound, further supporting the company's export business. Beyond company-specific factors, broader macroeconomic tailwinds could work in Polycab's favor. Rising infrastructure spending, coupled with Polycab's expansive distribution network and aggressive capex plans focused on backward integration, positions the company well for continued growth in the years ahead. In terms of the company's valuation, Polycab, being the market leader, trades below its median EV or EBITDA multiples of 26 times. Apart from this, the company even trades at the same price to sales multiple which was available in 2021. Another highlighting factor here is that even though it is the largest player and market leader, the company trades at the best PEG ratio of 1.48 times compared to its peers. Now that we understand Polycab India Limited's position in the cables and wires market, let us examine what UltraTech Cement's entry into this segment means for the industry and how concerned investors should actually be. As part of the Aditya Birla Group, UltraTech Cement recently announced plans to invest 1,800 crore rupees in setting up a cables and wires manufacturing facility in Bharuch in Gujarat, with operations expected to begin by December of 2026. Now, this move comes at a time when the Indian wires and cables industry is valued at 84,500 crore rupees in FY24, and it's already witnessing substantial expansion, with key players ramping up capital expenditure. UltraTech's foray into this space introduces new competitive pressures that could reshape the industry's landscape over the next decade. Interestingly, UltraTech Cement's own stock also took a hit on the day of the announcement, dropping over 5% and erasing nearly 15,000 crore rupees in market capitalization. This decline was driven by investor concerns that the company might be diverting focus away from its core cement business, prompting a knee-jerk reaction in the market. But is the entry of UltraTech really a big deal? Well, the announcement of UltraTech Cement's capex plan did spook the cables and wires industry, and understandably so. As a cement major and the flagship company of the Aditya Birla Group, UltraTech brings deep pockets and significant industry influence. The immediate reaction was evident in the market, with most cable and wire stocks crashing on February 27th, driven by concerns over margin consolidation. At present, the 4 biggest players in the industry derive the majority of their revenue from the cables and wires business segment. Investors feared that intensified competition would put pressure on pricing and profitability, leading to stocks hitting lower circuits. These concerns are not entirely unfounded. Firstly, Once UltraTech's manufacturing facility in Bharuch becomes operational, the company could achieve an asset turnover of 4.5 times, potentially generating 8,100 crore rupees in revenue a year. Analysts believe UltraTech will start capturing market share by FY28 in both the cables and wires segments, which could disrupt the existing industry dynamics. Secondly, one of UltraTech's biggest strengths lies in its extensive distribution network, which could provide a significant advantage in the cables and wires business. Being part of the same construction value chain, UltraTech Cement has a pan-India distribution footprint with 132,000 plus channel partners, 1,300 plus warehouses, and 250 plus railheads. The company's logistics operation is equally impressive, managing over 11,600 trucks and 38 rakes daily, demonstrating its ability to handle complex B2B supply chains at scale. This established network could enable UltraTech to quickly penetrate the cables and wires market, leveraging its deep industry relationships. From a strategic standpoint, UltraTech's foray into this segment aligns with the broader trend of shifting from the unorganized to the organized sector in the cables and wires industry. This move positions UltraTech to capitalize on industry formalization, potentially disrupting existing players like Polycab India. Thirdly, UltraTech's entry is further strengthened by its sister company, Hindalco Industries, which is a major player in aluminium and copper production, the key raw materials for the cables and wires sector. In 2023, Hindalco produced 400,000 metric tons of copper cathodes and 340,000 metric tons of cast rods, making it a critical supplier in the value chain. UltraTech's move into cables and wires represents a forward integration strategy, leveraging Hindalco's expertise in metal production to streamline supply chains and reduce costs. With copper and aluminium accounting for 70% of the total costs of goods sold, UltraTech's access to raw materials at a competitive price could give it a substantial cost advantage, allowing it to price products more aggressively and gain market share quickly. What does forward integration actually mean? Well, it is a process that allows a company to expand its control over the later stages of its supply chain, including distribution, retail, and after-sales services, while still managing earlier production phases such as raw material acquisitions and manufacturing. This strategy enhances efficiency and cost advantages. For UltraTech Cement, forward integration into the cables and wires business is highly feasible as it can leverage Hindalco's supply chain. With Hindalco being a major producer of aluminium and copper, UltraTech can streamline procurement, ensure competitive raw material costs, and strengthen its pricing power, positioning itself as a strong player in the industry. All this may sound scary for Polycab India investors, but hear me out, it's not all doom. While UltraTech Cement's entry into the cables and wires industry initially caused panic, these reactions are largely short-term. According to industry experts and analysts, immediate competition from UltraTech is unlikely, as the real impact will only be felt once its cable business becomes operational and gains momentum. However, analysts remain divided. Jefferies India, Citi and Macquarie remain optimistic about Polycab India's growth potential, while HSBC has taken a more cautious stance, even lowering its target price for the stock. For instance, here is what the analysts from Morgan Stanley say. Brokerage firm Morgan Stanley on Wednesday, March 5, projected a nearly 52% upside on shares of wires and cables major Polycab India Ltd. The brokerage has given the stock an overweight with a price target of 7,395 rupees per share. HSBC, on the other hand, has cut Polycab's target price by 20%, citing potential margin pressures. That said, for UltraTech, it won't be an easy entry. Established players like Polycab and KEI Industries have built a strong market presence, making it difficult for a new entrant to capture a significant share quickly. Additionally, most cable and wire companies have already committed substantial capex to expand their manufacturing capacities, reinforcing their dominant positions. The industry itself has been on a steady growth trajectory, expanding at an impressive 25% CAGR over the last 4 years. Coming to Polycab India in particular, the company's fundamentals remain strong. Its ability to manage pricing pressures, maintain its leadership position, and sustain its export momentum will be critical to its long-term success. Polycab's commitment to innovation, cost efficiency, and global expansion will act as the cushion against potential pricing wars, if any. For now, Polycab's strong order book, strategic expansion plans, and solid financial health act as safeguards against short-term market volatility. With India's infrastructure sector booming, Polycab is well positioned to maintain its leadership, provided it continues to execute its growth strategies effectively. The next few quarters will be crucial in determining how the competitive landscape evolves and whether UltraTech's foray is a genuine long-term threat or just a temporary disruption. What do you think? Will Polycab remain the dominant force in the industry, or will UltraTech shake things up? Let me know your thoughts in the comments.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.